Good morning, everyone. Thank you for joining us today. We are here discussing protecting your pot of gold. Why do leprechauns get to have all the fun? With St. Patrick's Day on our minds and just around the corner, believe it or not, we're already in the middle of March. We wanted to give you some tips on how to keep the most money if you find your very own pot of gold. I'm here today with Ken New, owner of Pinnacle Financial Wealth Management, to discuss this further. Ken, can
Hey,
you
Gina.
elaborate?
Glad
What
to
do you
be
mean by
here with you.
Yes, I'm so happy to have you here, as always.
Yeah, absolutely. I find it so interesting too, because not only is it almost St. Patty's Day, but it's almost the end of the first quarter of the year.
Yeah,
I mean, this year is flying by. And so we get to take a time out for a moment and talk a little bit about finance and talk about
absolutely.
taxes and talk about, what's going on in the world today.
Yes.
So in the area of finance, for most people, this pot of gold could show up in a variety of ways, but for most people, it shows up as hard earned savings, money that's put away for retirement or for a special purpose.
Mhm.
However, it could be one of those events in life too, where you sell a piece of property, you get an inheritance, you might sell a business. And so there's this larger sum of money that shows up. And so the point of it is that there is a reckoning at that point, and we start to talk about the biggest costs associated with taking income in retirement and holding on to our assets, and that's called what? Taxes, right?
Yeah.
Right. Uncle Sam is there. He always wants his cut, especially on large sums of money. And the thing about it is, in today's world, essentially we face a higher tax environment. We're looking forward and thinking, oh, wow, taxes have got to go up in the future. Almost everyone will give me that feedback. But the opportunity that we have today is very, very unique because we have the lowest taxes in 2 generations, in like 50 years. So we have a very excellent tax environment. But here's the thing. The opportunities themselves won't be present forever. And here's what I mean. The average person has that pot of gold in their retirement plan. That could be in an IRA, a 401k. It could be in any kind of tax-deferred retirement plan. And what's interesting about that is I'll tell a little bit of a story, I think, to help accentuate this point. I ask very often, there's $1 million in the 401k. And I said, well, how much of that is yours? How much of that are you going to be able to use and you're entitled to and so on? And most of the reaction is, well, it's all mine.
Yeah.
And
Right.
really, it gets down to how much can you get out of it for your own use, versus the idea of what the taxes would be. So the story I tell is let's just say that you wanted to borrow some money.
Mm-hmm.
And I was going to loan you the money and $10,000, $100,000, whatever the number is. I was going to borrow that money to you. And I said, okay, so your question then would be what? 2 basic things you want to know. Number one, what's the rate of return? Okay, what do I need to pay you for it? And how long? Okay, what's the duration? How long are you going to do that for? And I would say to you, well, hang on a second. I don't really need the money right now. Okay, so let's hold off on that rate of return and when you got to return it and things like that. And then when I do need the money and I know how much I need and how fast I need it, then I'll let you know what the rate and what the term is. What would you say to a deal like that? Well, you wouldn't touch it with a 10-foot pole. Are you kidding me? You're not going to tell me what the rate is? Why would I do this deal with you?
I'd be a little suspicious there.
Isn't that what Uncle Sam's got going on with our 401ks and our IRAs? Is that, we don't know what we're going to pay, what we want in taxes yet, but we can change it anytime. So there's a chance that we're going to, make a change to it and we'll let you know when we need it. And then we'll let you know how fast we need to get it out of there. And the point of it is that, it's something that it creates this opportunity that maybe we should become aware of today. Is maybe we should be thinking about the lowest taxes in a couple of generations and whether or not there's some strategies and that type of thing that might be in our best interest to be able to get more control over that money and have some certainty as to what it's going to cost us when we pull our money out of our retirement plan. Does that make sense?
Yeah, absolutely. So speaking of taxes, I can imagine I would have to pay taxes on my pot of gold. But is there a way to help me keep more of my money?
Well, I tell you, the number one strategy, I think, when you've got money in an IRA, that hard-earned savings for retirement, the number one strategy, the one that I ultimately love the most out of all of them, is the Roth IRA.
Mm-hmm.
And specifically the conversion, the ability to be able to take the money out of the IRA and convert it to a Roth IRA. Now, why would you want to do that? Well, it's a tax strategy. Okay, so we really need to take a look at what that would look like to see that it's in your best interest. And it invariably would be. Why? Because taxes are so favorable today. But the main thing is that the Roth IRA, there's no upfront tax deduction. In fact, the conversion would cost taxes in today's tax law.
Okay.
Right? Now, so that's the bad news. And that's really the only bad news associated with it. The really good stuff is that you can take the withdrawals when you want to, if you need to. You control that. All right? So there's no minimum and distributions, and you're not required to take it out. In fact, you can pass it on to your beneficiaries. Now, they'll be required to take some money out, but it's tax-free to you if you use it for income, and it's tax-free to your beneficiaries. Okay, so those are really good things that are associated with that.
Very important.
And why it might be in their best interest.
Yes.
Yeah. All right, and so, essentially we call that a backdoor Roth IRA because you do a conversion. Many people are contributing to Roth IRAs in 401ks and so on. And again, I love the Roth IRA. Why? Because you are in control of the taxes. Why are you in control? Because you pay at today's tax rate. Well, today's tax rates, we're still benefiting from the Jobs and Tax Cut Act that President Trump put into place. But guess what? And really make note of this, everyone. Those tax cut laws will sunset December 31st, 2025, right? They are temporary. That gives us about a 4-year window to take advantage of it. And it may make a lot of sense to people. I have a colleague of mine who did some analysis on the traditional IRAs, and just at today's tax rates, over a lifetime of taking money out of $1 million IRA and passing on beneficiaries and them taking it out of the $1 million IRA, that account would generate over $800,000 of taxes for $1 million IRA or 401k. I mean, these are numbers not only just having to do with the federal tax, but also the Medicare premiums that are associated with it. All right, so the point here is that taxes are in our future. It's the biggest cost associated with taking income and growing assets. And I think that the Roth IRA, the Roth IRA conversion, that is your number one strategy for overcoming this tax issue.
Ken, I'm going to backpedal just a tad bit. Can you kind of just elaborate more what the tax law was implemented back in 2018? And 2025 is around the corner. We're already almost halfway through 2022, believe it or not. But just for everyone watching, in case they have any concerns on what it is or don't even know what it is, can you just give us a little?
Yeah, absolutely. So what it is that there, for a married filing a joint return, are kind of the numbers that is the most common. And what that means is that for a married filing a joint return, that we could take of taxable income over $100,000 and pay an effective rate of just under 10%. Now, generally, when I say that to a group, say I have 100 people in a room and I make a statement like that, I say, what do you think about tax laws? And what do you think about tax? And they go, oh, yeah, I mean, they're killing me right now. Well, you know what? The lowest they've been in a couple generations. And then I say, well, what if I could tell you that you could get over $100,000 of taxable income out of these accounts, and your effective tax rate would be 9.8%, just under 10%. And they go, oh yeah, that's the tax law we're talking about. Use that tax law. We don't know what it'll look like in the future. We don't even know if it'll go up, but what are the chances? Pretty significant, yes.
Yes, thank you so much.
So that's the metrics of it is that the base rate is very low, and then we continue to move on up, and it's the effective amount of taxes that you're paying. Look, the tax brackets themselves is a consideration, but that's not the answer. It's the amount of taxes, the volume of taxes that you're paying. That's what you would want to pay attention to.
Yeah, most definitely.
Yeah, for sure. So that's what the Roth IRA and why it's so powerful.
Mm-hmm. And is there another way?
The number two strategy that I talk to those that have meaningful wealth is that, and I'm talking about $1 million, several $1 million of assets.
Mm-hmm.
And that is the use of permanent life insurance, cash value life insurance. Now, permanent meaning that you have a policy that you expect to hold until your end of life. But during that period of time, you're able to accumulate large sums of cash. And guess what? This year, we have a new tax law, and that tax law allows for us to put more money into permanent life insurance. And I don't think that was intended when they passed the tax law. However, because the way that it's figured, the amount of cash that we can put into life insurance policies has been increased. And of course, the death benefit is a tax-free death benefit that goes to the beneficiaries. So it's a great estate planning tool, but it's also a beautiful tool for those during their lifetimes to be able to pull money out and not have it be taxable, contribute to that income, that ever-increasing need for income that life insurance affords. So, and here's kind of one of the key things is, especially when you think about government intervention and taking a look at taxing things is that just the fact that they limit the amount of money that you can put into cash value life insurance means that it must be pretty good.
Right. Yeah, absolutely. I've been hearing a lot more about life insurance lately. And I feel like it's like a hot commodity. I don't know if you can agree to that.
Oh, well, I tell you, it's been a hot commodity over the last couple of years because the inflows into that asset class are at record highs.
Yeah.
But I will tell you this, and that is that permanent life insurance has been around for a couple of hundred years. There's a great book out there, What Would the Rockefellers Do? All right. That's a great book for anyone who, again, wants wealth preservation and to pass on to the generations, because the Rockefeller family and the book, What Would the Rockefellers Do, talks all about their use of what they call the family bank, okay, which is really cash value life insurance at the core of it. So, great read for those that really want to dive into it. There's another program out there called the Infinite Banking System, which I consult with several clients about as well. So the beautiful thing in today's law is they actually increase their ability to put more money into it. And again, I think that was an oversight on their part. So another great opportunity just to take advantage of a very strong product. So there you go. That's my number two is cash value life insurance for those that it's appropriate.
All right. So we have Roth IRA conversion. We have insurance, life insurance.
Yeah.
And what else? What else can we do?
One of the greatest concepts, I think, especially for those that are younger than 65 years old, is called an HSA, a health savings account. Why? Because you get a tax deduction when you put money into the policy. It grows tax-free, and you can pull the money out tax-free. It is the only product out there that gives you 3 ways to save taxes. Again, putting money in, tax deduction, current year.
Yeah.
It grows tax-free, so you don't pay any taxes on the growth, and then you can pull it out and escape paying taxes on it. Now, it's designed to be used for healthcare in most cases, but it has a broad definition of what that is. So lots of uses for it. And, here's the thing. I have clients that have several hundreds of thousands of dollars in these HSAs that they've contributed to over the years. There's limits to what you can contribute to. But here's the point is that they're just allowing them to grow. Because now, as you get older and older and older, next to taxes, or maybe even in front of taxes, what's your biggest cost in retirement? Healthcare.
Yeah.
And this money can be used for any of that. So it's a great opportunity to add to that bucket of money that you're used for healthcare costs late in your retirement time.
Awesome. And we, so many of us know the term HSA. It's part of our everyday living, especially working, right?
Mm-hmm.
So yeah, I didn't even know that you could use it as an investment. So I appreciate that. This is why I love
absolutely.
Lives.
Yeah.
All right. So we have our third one was HSA. Is that all, or is there one more?
There are other strategies out there. These top three right here, you should incorporate and make all those happen. I think this covers the average person's strategies that are out there. And the reason why I say that about the HSA is that you have to have a high deductible health policy.
Yeah.
All right. And you know what? The point of it is that they're all high deductible anymore.
Yeah.
Because they're so unaffordable. The employers are passing that on to the employees, so they qualify. And if you're self-employed, or if you have your own policy, it may be in your best interest to have one of those high deductibles, because the premium costs are so high associated with that. So yeah, those top three really are the strong ones. I think this will be a good strategy for many people.
Awesome. Well, thank you so much for taking the time out of your day and joining me on this Facebook Live.
Absolutely. Yeah, it's great to be on board with you. Great to talk about taxes, and especially about how to save in taxes.
Yes, absolutely. So I didn't attach, but I will attach your Calendly link in the description above for everyone watching. Click on your Ken's Calendly link, schedule a call, and he will discuss with you and help you find the strategies that work to best protect your individual pot of gold. I look forward to our next Facebook Live.
Absolutely.
All right.
Well, thanks a lot for having me, Gina.
Yes,
have a great day today.
Yes, you too. Okay.
Bye for now.
Bye.